Welcome, everyone. My name is Michaela Klauser. I'm the Associate Director for the Producer Education Team here at NCBA. I'm pleased to welcome you all to our webinar, End of Year Tax Considerations. As a participant, your line will be muted, but feel free to type in questions in the question box on your screen during the webinar, and at the end of the presentation, we will get to as many of those as time will allow. If you have trouble with your technology or if you're joining only for the audio, the webinar will be recorded and will be available for viewing in a few days at ncba.org. Just look for the Producers tab. Tonight's webinar will feature Danielle Beck. Danielle joined NCBA's Washington, D.C. team in June of 2016 as Senior Executive Director of Government Affairs. Danielle leads NCBA's business team of lobbyists and oversees our engagement on all policy issues pertaining to a cattle producer's ability to make a living and operate a successful business. Prior to joining NCBA, she represented clients across the food and agriculture sector as a lobbyist for the Russell Group. Before that, Danielle spent 5 years on Capitol Hill working for Congressman Tom Rooney of Florida. Also joining us tonight as a presenter is Paul Neiffer. Paul is an agribusiness certified public accountant and business advisor specializing in income taxation, accounting services, and FSA public planning related to farmers and processors. He is a nationally recognized speaker on many subjects related to farmers and processors, including tax planning, estate tax and succession planning, farm management accounting, the Farm Bill, and farm economics and other related topics. Paul is a past president of the Farm Financial Standards Council, which is the premier organization promoting the use of accrual basis financial statements for agricultural producers. So with that, Danielle, I'm going to go ahead and pass it off to you.
Thanks so much, Michaela. Good evening, everyone. In terms of a year-end update, very excited because we have made some really positive developments on the tax sphere, and when it comes to tax policy issues, we are driven by our policy. We're a producer-driven organization. If you've attended NCBA's Tax and Credit Policy Committee meetings, you've likely heard from both Paul Neiffer and myself about many of the issues we'll cover tonight. But the basis of all of our efforts really surround the fact that cattle producers deserve fairness and certainty in the federal tax code. And that is whether you are trying to operate a viable business and manage your annual tax burdens, or you are trying to transfer your business to the next generation of producers. And so we have been engaged on a host of different policy provisions that are currently in play, but that has really been the goal here. And so really quickly, we can touch on some of the initial revenue raisers. I think it's always helpful to put in context, sort of where we started versus where we are today. So where we started, the American Families Plan was President Biden's initial proposal that really posed a triple threat to family-owned agricultural businesses. The first leg of that stool was higher taxes on operations. The second leg would be higher taxes on the sales of their businesses, and then higher taxes when past the next generation would be that third stool. And so we were looking at top rate increases on your small business taxes, a 3.8 net investment tax, eliminating or greatly reducing that 199A small business deduction, restricting or eliminating Section 1031 like-kind exchanges, a capital gains rate hike from an effective rate of 23.8% as that top rate to 43.4%, and then looking at eliminating stepped-up basis and effectively imposing a double death tax. I'm very pleased to report that we have made quite a difference, and one of the reasons that I credit that difference is because of our ability to quantify the impacts. And so NCBA participates in the Family Business Estate Tax Coalition. We serve on the steering committee, and even before the presidential election, the steering committee really looked at how are we going to be best prepared. There is a chance that President Trump doesn't win a second term. If that's the case, looking at all the different Democratic candidates, we know that stepped up basis might be on the chopping block. And so we really need to figure out how to defend that provision. No data had been done quantifying economic impact, and so we commissioned EY for a study that demonstrated exactly how harmful it would be. Basically, job equivalents would be decreased by approximately 80,000 jobs in each year of the first 10 years after enactment, 100,000 jobs in each year thereafter. We would be looking at a decrease in the US GDP around 10 billion annually, or 100 billion over 10 years. And for every $100 of revenue raised by a repeal of stepped up basis by a tax at death, the wages of workers would decline $32. So 1/3 of every dollar of revenue raised would come out of the paychecks of US workers. That's tremendously detrimental, but more importantly, we have data that looks at the impact on ag producers. So the EY study has 5 different case studies in it, one of which is a theoretical case study on a cow-calf operation, and that was at our request. And so we looked at a cow-calf operation that would have been based in the Sandhills of Nebraska, and the results effectively showed that that producer would face a one-time tax payment that would be 280% of that operation's annual income. And that was an operation built or purchased in the 1990s or in 1990, not an 8th generation operation that had been passed on, dating back even prior to that. So that's been a really, really useful and powerful tool in terms of how we engage with Capitol Hill. It's been a little frustrating to see folks like Secretary Vilsack's defense of the president's proposal. Understand, he has to tout the proposals of the individual who hired him, but he indicated that we would see only 2% of US farms and ranches impacted by the American Families Plan. But we know that that is absolutely not the case, because there have been several different land grant studies that really quantify, based on a host of data that they have from real life farms and ranches, what the impact would be. And so they found that the average tax liability of the STEP Act on family farms would be a national average tax liability of $726,000. The STEP Act mirrors the president's proposal. It's a bill that was introduced in the Senate by Finance Chairman Wyden. If you see here on this screen, it also breaks it down regionally. The tax burden varies depending upon where you are. In the Southeast, it's a little bit lower, whereas out in the Midwest, it's over $1 million. So either way, really great data pointing to the fact that this will absolutely increase the burden on family-owned agricultural operations and make it that much harder to pass your businesses on to the next generation of producers. I credit the reason why NCBA has been so successful, though, because of all the hard work that the folks on this call have been doing, along with all of our membership across the country. You all are absolutely making a huge difference, and I'm so incredibly grateful for all the wonderful grassroots engagement that really has played into this conversation. All politics is local, and the fact that so many of you have taken the time to reach out to your members of Congress, weigh in, that is making a huge, huge difference. And so this screen here is just a snapshot of the timeline of what's been playing out since March. Obviously, we are now in December, so these 5 months really only cover a small portion of it. But if you look here, we've seen multiple bipartisan legislative proposals that would repeal the death tax, preserve family farms further by expanding 2032A special use valuations. We've seen a tremendous amount of bipartisan support by way of coalition letters from folks in both sides of the aisle, both chambers, in defense of critical provisions like stepped up basis. It has been wonderful to witness. In June, NCBA launched our Tax Talks podcast. So we have our annual Beltway Beef podcast. We developed a podcast within a podcast for folks on Capitol Hill that talks about tax policy issues. We've done 5 of those podcasts, and cumulatively, they've received more than 3,000 listens, which is the most listens I think any tax or any podcast series from NCBA has received. They have the highest click-through rate, and it's because we are doing a really good job educating all of the folks on Capitol Hill that may understand agriculture but don't understand tax policy, or understand tax policy but don't understand agriculture. And we featured a ton of our producers and their personal impact stories through those podcasts. Paul was one of our special guests. I think he was in our inaugural podcast guest, actually. One of my favorite efforts was a coalition effort in which more than 320 food and agriculture trade associations from across the country signed onto a letter in defense of critical provisions like stepped up basis, preserving the current estate tax relief that we were able to secure under the Tax Cuts and Jobs Act, preserving like-kind exchanges, the 199A deduction. Before this letter was sent, we had seen a leaked version of the Ways and Means proposal that I'm sure Paul will touch on in a little bit, and stepped up basis was still on the table then. They were talking about, some quote unquote protections for farmers and ranchers. We knew those were untenable. I have never seen such an outcry or such a large coalition effort from Food and Ag and all my time in DC. And that afternoon, Secretary Vilsack put out a sort of scathing op-ed in response saying, again, only 2% of farmers and ranchers will be impacted here. It's my understanding, I heard through the grapevine, that was a direct response to the buzz that this letter created. And that could not have happened without all of NCBA's state affiliate organizations who are such wonderful partners, and so many producers who reached out to other ag trade groups that they work with at the state and local level to say, hey, this is going on and you should join on. So really proud of that effort because it's made a tremendous difference. So congressional action. Again, Paul is going to cover this, but on November 3rd, the House released a revised reconciliation bill to implement Build Back Better agenda, a lot of changes to what the original revenue raisers were. We know that this bill still has a long way to go before final passage, but they are currently in the process of figuring out how they're going to do that in the Senate. There are 3 relevant potential tax changes that, again, I think Paul is going to talk about further, but this is sort of what I've identified as the core potential threats for ag producers. That 3.8% NIT, limitations on the excess business losses for non-corporate taxpayers, a surcharge on high-income individuals, estates, and trusts. Big ticket proposals not in the bill. So when I talk about all of the efforts that our grassroots community at NCBA has made a difference in furthering, there are no changes to stepped up basis. There are no increases to the top individual tax rate, no capital gains rate changes, no corporate income tax rate changes, at least from a major perspective, no changes to the lifetime estate and gift tax exemption amounts, nothing on estate valuation discounts or the grant for trust rules, the 199A small business deduction, 1031 like-kind exchanges are preserved, and there is absolutely no cow tax on methane emissions. That is a non-starter. It is not in the bill, and it will not be in the bill moving forward. So Senate consideration moving forward to this week. Right now the buzz in Washington, D.C. is that Majority Leader Schumer is going to get the BBB across the finish line before Christmas. There's something called the bird bath in DC. It's a wonky term. Remember, this process is moving through reconciliation, which is a mechanism that allows them to bypass any need for a filibuster. They can pass the bill with a simple majority in the Senate, and that requires them to move through a bird bath, which is a really wonky term in which basically Republicans and Democrats staff will meet, review different provisions of the bill, and determine whether it passes this 10-part test. Budget neutrality is a big component of that. Right now, a lot of the CBO scores have come out on the House passed proposals for Senate consideration, and bird bath meetings have already taken place on some of the less important, at least in the context of this conversation, portions of this bill. They have not gotten CBO scores, nor have they had any formal bird bath meetings on the Senate Finance Committee or Help Committee components. And those are where the bulk of the revenue raisers and spending, at least in terms of needing budget neutrality, lie. Everybody on the Hill, if you're talking to Democratic majority, Democratic leaders, they're convinced that this is happening before Christmas. But to color in details and some context, they also intend to do something on the debt limit. There are several other must-pass items. They're getting closer, but there's a lot of fatigue, very little bandwidth, and there isn't consensus among the party. Senators Manchin and Sinema are the final holdouts. I will say, though, really important to note that if they are looking at changes and there is a situation in which the score is not great and they need to find additional revenue, I think it is far more likely that we will see provisions struck that cost something as opposed to a bill in which they are looking for additional revenue raisers, meaning they bring back changes to the estate tax, changes to step-dip basis, like-kind exchanges, you name it. I believe, and I'm going to knock on wood quietly, that we are in the clear there, and that is thanks to all of our producer engagement. But that doesn't mean we're there yet, because if we don't get this done before Christmas, that means it will bleed into the new year. And with more time, there's always additional opportunities for bad proposals to gain legs or momentum. And we are going to have to continue fighting until the ink is dried on the president's pen, or this is dead and not moving in the Senate, period, one way or the other. So with that, I have a question slide, but it's probably more appropriate for me to pass it over to Paul, let Paul really dive in on these tax provisions, as well as a few other considerations, and then perhaps we can both take questions.
Thank you, Danielle. We'll go ahead and get started here. I'm getting a little, okay, I'm not getting the feedback now, good. So let's go ahead and get started. You guys are farmers. I'm gonna skip through this slide. I thought I'd fix that. So hold on a second here. Danielle touched on it briefly, but Congress and the media had always referred to it, and even Danielle sort of referred to it as being an elimination of step up in bases. And really what was happening is the proposal really didn't eliminate step up in bases. It required a transfer tax, a tax anytime you did a transfer of your assets to the next generation. Now this transfer could have occurred during lifetime, or it could have occurred at death. And so you were still going to get step up, but you're going to pay a tax at it. Now they allowed an exemption. The exemption was maybe in that $1 million per person range. I know Danielle and I both had heard some rumors toward the end of of sort of the discussion on this that maybe they would bump the exemption up to maybe 5 million. Maybe for family ranches, it might be 25 million, but that never really went anywhere. So this, as Danielle said, as of right now, this is completely off the table, but I at least wanted to bring it up. And the one thing I'd like to leave is just a quick example how draconian this proposal was. Let's take, sort of that ranch operation that Danielle was talking about that might be worth 20 million. And let's say that, that the equipment's been fully depreciated, the cattle have been all deducted, it's raised breeding stock, it's raised heifers, raised steers, and so on. And let's say that the cost basis on that is, let's say there's 10 million of those assets and the cost basis is essentially zero. That's very, very common. And let's say that there's some debt on there of $6 million, just as an example. So the net worth of that part of the cattle operation is only $4 million. Well, if Biden had gotten his proposal all the way through, likely that family farm would have faced a transfer tax of about $4 million, which would have completely wiped out the net worth of that operation going to the heirs. Remember, the transfer tax didn't care about debt, didn't care about net worth. It was based strictly on what was the fair market value of the assets before any debt. So I'm just glad that at least right now, as Danielle had mentioned, knocking on wood silently, that so far this isn't going to happen. So let's dive a little bit more into the Build Back Better Act, what's in there now. Excess business losses. Ranches are cyclical. 1 year you might make $2 million, the next year you might lose $2 million. You just never know based on the feed costs, based on the price of cattle and so on. And under current rules, you can only offset up to about $500,000 of those net losses. That's all the losses related to your ranching operation against other income. Now you might have had a capital gain from selling some ranch land. You might have some wages, you might have interest and dividends. So you can only offset it against, up to about 500,000. The current excess business loss was going to expire after 2025. The American Rescue Plan passed back in March, extended for a year. This makes it permanent. And the more major issue is under current rules, that excess business loss that gets carried over to 2022, let's say, is treated as a net operating loss, and it allows us to offset 80% of all other non-business income, which can be a pretty good deal. Well, what this proposal does is it changes where it is now part of next year's business loss calculations, and you can only offset $500,000 of total business losses against other income. So I have a quick example here. So, we got Sue for 2021. She had a $5 million farm loss. She's got $2.5 million of other income, whatever it might be, wage income, because wage income is not business income, interest, dividends, capital gains, and so on. She can only offset $500,000 against that $2.5 million. The $4.5 million carries forward to 2022 as an EBL. Let's assume she breaks even on the farm or the ranch and still has $2.5 million of other income. Current law would allow her to offset $2 million, so she'd only be taxed on $500,000. The new law, if it goes into effect, we can only offset $500,000. So effectively, your maximum NOL going forward, not the carryovers that you might have from the past, but going forward is only going to be $500,000 for a married couple. So this is a pretty big deal. It raises almost $200 billion over a 10-year period. There's also, if you have high income, you're going to have a 5% surcharge. Now this applies if your income's over $10 million. This is before any itemized deductions. It's before the Section 199A deduction. So if you end up selling some ranch land and you have a pretty good gain on it, it might apply to you. I think for most operations probably wouldn't apply, but the one where it really certainly can apply is the estates and trusts, where you have that $200,000 level. And I have another example here in a second on that. I forgot to change my slide. There's also an extra 3% surcharge if your income, again, this is adjusted gross income, is over 25 million. So again, for most ranch operations, probably not going to apply, but the estates and trusts is where it might. So let's take a look at that. Some of you probably farm as an S corporation, and you may have inherited that S corporation, and as part of that inheritance, it got stuck in a trust. You couldn't get it out of the trust, and we had to elect what's called an electing small business trust. Well, right now, if these proposals goes through, even though you might push that income down to the beneficiary, it doesn't matter. All the income related to that S corporation is now going to be taxed at 37%, plus the 5% surtax, plus the additional 3% surtax, plus the 3.8% net investment income tax, or a top rate of 48.8% plus state tax. And if you're in California, that would be a little bit over 62%. So that adds up really, really quick. But for most farm operations, still not too bad of a deal unless you're in one of these situations. Danielle had mentioned the net investment income tax. This is going to affect you, maybe not every year, but certainly years where you have a decent amount of income. Right now, you're already faced that extra 3.8% tax on interest, dividends, annuities, royalties, and rents. However, effectively what this says is if your income before itemized deductions and so on, and the Section 199A deduction, if your income's over about $450,000, you're either going to be subject to the 3.8% self-employment tax or the 3.8% net investment income tax. So as a rancher, that means your S corp income, your partnership income, if you pay yourself commodity wages, your self-rental income, the rental income that you're self-renting to your entities, you add that all together, the excess above that 450,000 is all going to be subject to 3.8% tax. This is the one likely to affect most of our ranchers out there. The EBL, that'll affect some, but this will definitely affect more. Again, the threshold, it's 500,000 for a married couple, 400,000 for other taxpayers. I should put a K after that 500. It's not $500, it's 500,000. You notice for trusts and estates, it's only 13,450, and there's a little bit of a phase in of it, so it's not too bad. Or I shouldn't say it's not too bad. Now, for those on this call, they're lucky enough to have a retirement plan or an IRA that's over $10 million. You're going to have to kick some of that out. There's now a new 50% RMD if your balance is over 10 million. There's no age. It's not age 72. You could be at age 24, and this would apply to you. Now Roths, if you have more than 20 million, you have to get rid of 100% of the excess. We can blame that on Peter Thiel. He's the person that's got that $5 billion Roth account out there. He was one of the co-founders of PayPal. So just one of those changes. I just threw it in there because it is in the bill right now. Roth IRA, they're going to eliminate the backdoor Roth and so on. That might apply to some of you. Again, this was in the bill, then it wasn't in the bill, then it was back in the bill, all in the span of 1 week. So this is very much a moving target right now. I'm sure you're definitely thrilled to hear that the IRS is going to get an extra 80 billion to go out and hire about another 80,000 IRS auditors supposedly. I don't think they're going to find them, and it's going to take them 5 years to actually get learned anyway. So I'm not too worried about this. EV tax credits. So if you want to buy a pickup, and as long as it costs less than that 70, I can't quite see on my screen here. I think it's 74,000 or approximately 75,000. You could get a $12,500 credit for union-made vehicles. Now, this wouldn't be Tesla, but the new Ford Lightning that's coming out next year, that would apply. Whereas if it's not a union made, then the credit, I think, is $8,000. Now there's a phase out and so on and so forth, but that's something to be aware of. And then last, there's still, the Senate is certainly churning on this right now. We know that tax reform limited to $10,000, the maximum deduction that we could take for state income taxes, personal real estate taxes. The current bill increased that up to 80,000, and then it reverts back to 10,000, I think, for 1 year in 2031. Likely the Senate is going to cap this at somewhere in the $400,000 to $500,000 range. Senator, I think it's Menendez of New Jersey, is pushing for $1 million cap. But Senator Bernie Sanders, our friend Senator Sanders from Vermont, and I use that term loosely when I say friend, he's pushing for that $400,000 to $500,000 level. This will definitely change. The 80,000 is going to be gone. Items that were proposed but not in the bill, Danielle sort of briefly touched on them. I'm going to go ahead and just jump through them a little bit just to give you an idea. Hopefully these will never come back, at least in this bill. I tend to agree with Danielle. If there's changes because of the bird bath and they have to reduce the amount, they're not going to raise revenues to offset it. They're likely going to cut items. Manchin's already really put his foot down on that, so we'll see if that happens. But S corporations, this actually was a good proposal. There's some very large Democratic supporter out there that had set up an S corporation as of May 13th, 1996. Always been an S corporation since then. Well, for all of you farmers that have an S corporation and it's been around since May 13, 1996, you were going to have a 2-year window next year and the year after to liquidate it tax-free and then be taxed as a partnership. If this had passed, I would have been all over this. I would have had lots of S corporations that I would be liquidating and then treating them as partnerships, but that's not in the bill. Corporate tax rate, again, this is something I think as a rancher, I would actually like this. Right now, you face a flat 21% rate on all of your C corporation income. Here, this would do an 18% rate on the first 400,000 and then gradually get it higher than that. And Biden wanted a top rate of 28%, but again, not in the bill. We know both the House originally and Biden wanted to have a top rate of 39.6%. This has been around almost 30 some years now. It was put into effect in the early 1990s under President Bush #1. But this is not in the bill. And we can thank Senator Sinema of Arizona. She's the one that put the kibosh on this. Capital gains, we certainly know that President Biden wanted to bump this up to 39.6% on income gains over $1 million. The House said, well, we're not going to go that high. We'll do it at 25%. However, again, not in the bill, so that's good. No changes there. Qualified business income, I think possibly some changes in this will come back. The House wanted to limit the deduction to 500,000 or 400,000 single, but if you get a DPAD from a cooperative, there was no changes on that. Senator Wyden had issued a proposal about 3 months ago saying if your income's over 500,000, you get no deduction. He's a very important person in the Senate. He's the chair of the Senate Finance Committee. This one, Danielle, I would say this one still got a chance to coming back. Some changes on this might come into play. And if that happens, could affect some ranch operations, but maybe not. Unified credit, good news, no changes. And the one thing that we should understand is throughout the history of the estate exemption, it has never gone down. Even though this is scheduled to revert back to the old 5 million index, which will be close to 7 million by the time 2026 rolls around, maybe 6.5 million, somewhere in there. I still think there's a good chance that we'll still keep the $12 million exemption. I think there's enough concern by lots of Democrats or Democratic senators, Democratic House members in those key rural states, especially those senators that have quite a bit of clout, that this is something that I think it's going to be difficult for them to drop. Now it might happen, but again, it's not in this bill, which is good. One thing that would have been nice for ranch operations, farm operations, especially with the rapid appreciation in farmland values here in the last year, is they were going to increase the Section 2032 Cap A deduction. That's when if you inherit farmland or ranch land, and the net rental value of that is substantially less than the fair market value, we're able to drop that down. Now, in current rules, it's only about 1.2 million. So they basically wanted to increase it by 10 times and make it 11.7 million. Now, it sounds great, but here's the issue. You get no step up on that excluded amount. It has to be farmed by the family and done properly, both before the person passes away, then for at least 10 years after that. There's a lien on the property during that 10-year period, which can create some financing issues. And remember, you're not getting any step up. There is no step up on that excluded amount. And even if you mess it up and you're going to have to pay back part of that tax that you saved, if you take it out of that special treatment, you don't get any full step up. You only get the step up based on the tax paid. So this always sounds great in theory. And then definitely the definition of family. Cousins are not family. A lot of ranch operations are now going to cousins. It's not necessarily going to sons and daughters. So this was great in theory, but the practicality of it wasn't as good. But again, not in the bill. 1031 exchanges, we certainly know Biden wanted to restrict this to $1 million gain for married couples, 500,000 for singles. The House never even had this in the proposal at all. It never was in there. The farm lobby, and as Danielle mentioned, I've been on several calls with the various ag lobbyist groups out there, including NCBA. And until this year, there might be 5 of them that would attend some of those calls. I think this year we had it seemed like we had about 60 on the call. So, Danielle's very, very correct that the whole ag community got together and fought this and did a very great job on it. I definitely commend the ag community. I think you're really the community that got that, quote, the elimination of step up in base is what I call the transfer tax, got that eliminated. A couple more items here and then we'll open it up to questions. A lot of turmoil on trusts. There was various proposals from Biden. There was proposals even, I think, in the original House bill that was first written up. Matter of fact, I'm pretty sure it was in there that any of these grantor trusts were likely going to be included in your state, and then distributions during lifetime were going to be treated as gifts. The intentionally defective grantor trust was going to be eliminated. The SLATs, the spousal lifetime access trusts, all the benefit of all those trusts, life insurance trusts, all those trusts that a lot of the ranch community out there as part of their estate plan. And part of it is to save taxes, but really a lot of it is to make sure that that ranch is kept in the family for multiple generations. It's not just tax reasons why we're setting up these trusts. They were trying to curtail the benefit of these trusts. None of this was in the bills. So that's very, very good news. And actually, I'll skip this slide because we don't really have to worry about that right now. They had proposed that you were going to have no discounts on non-business assets. Now you're thinking, hey, my ranch operation, that's a business asset. I still get to discount that. I'm not really worried about that. Well, think about it. Likely, you're going to have your ranch land in a separate entity. You might have an LLC, and you're renting that ground over to your farm or your ranch operation. That land is going to be considered a non-business asset. So that was definitely going to restrict our ability to transfer that ranch land onto the next generation at a lower cost. But this wasn't in the proposal. Doesn't appear it's going to come back. At least we're not hearing any chatter on that. And then with that, I'll leave that up there. The one thing, I think maybe several of you have already subscribed to our blog. It's called farmcpatoday.com. It's actually available through our website too, claconnect.com. I can't believe it, Danielle. It's almost been 13 years since I started that blog. But I would certainly recommend for those on this call to sign up for it, subscribe to it. It's very easy to do. You just put in your email address, first name, last name, and then every time we do a post, it'll get emailed to you. There's no cost. And probably, Danielle, I'm guessing this year, probably what, I've had 75 posts related to the new tax proposals, maybe 100 posts, something like that. So it's got quite a bit of information. And with that, we'll open it up for questions.
Great. Thank you so much, Paul and Danielle, for speaking tonight. NCBA is all about bringing the latest, most relevant information to the industry, and you both certainly helped us achieve that goal tonight. And with that, we'll go ahead and dive into some of your questions. So first question here states that it's not necessarily a secret that there's a narrative circling around that corporate ag is trying to get out of paying taxes, but we know that this is hitting hard those small family businesses and those family operations. So I guess the question would be, how do we tell our story to those urban congressional members and Senate members?
That's a great story. That's a great question. Paul, do you want to go first or do you want me to go first?
Why don't you go first and then I'll chime in.
Yeah, so I feel well positioned to answer this question because when I was a baby staffer starting out on Capitol Hill, I really didn't know a whole lot about agriculture, but I was very lucky to have producers, specifically many in Florida, who lived in the area and around that area where my former boss worked, take me under their wing and really educate me about ag and all the benefits of ag, whether it's sustainability and the land conservation, the wildlife conservation, water, you name it, all those benefits, specifically that cattle producers offer, the economic benefits, because you aren't only just family businesses, you're also supporting your local communities by employing a lot of them, or the work that you do supports the related industries around you all. I mean, whether it's transportation or your local ag retailer, I mean, it's tremendous. Talking about that, you name it, the social sustainability aspect of it, in which you really are the heart of rural communities across the country. And while there aren't necessarily a lot of staffers in urban offices or the offices of members who represent urban areas who come from that background, your stories are so compelling that you certainly won me over to the point where it's now my whole profession to work for this industry, and it's something that I derive so much joy and fulfillment from. You can pick up the phone and there is a staff assistant at every desk on Capitol Hill, although a lot of them might be still working remotely, who will answer the phone, and you can say, hey, can you connect me with your Ag LA? Oftentimes I find that the Ag LA or legislative assistant is far more receptive to hearing from producers than the tax staff are, certainly. But then saying, hey, you know, I'm also a business. I work hard at each and every day to produce this safe, affordable, nutritious protein. But I am, at the end of the day, a small business owner or family business owner, and here's how this provision impacts me. All of that makes a difference. And if you have friends or family members that are in those urban areas where, you know, they might be constituents, having them pick up the phone and tell that story is really impactful too. But I think grassroots advocacy, as somebody who formerly answered phones and then at one point, you know, responded to all those letters and incoming correspondence, it absolutely does make a difference. And all politics is local again. So hearing from folks on the ground in districts really does make a huge impact. But Paul, feel free to chime in here.
Oh, I definitely agree with what you've said, Danielle. The fact that you can tell a personal story that resonates with even people in the urban community. You know, they always hear the term corporate farm, and you know, really most of ag is not what I call corporate farm. And the more that you can tell that story, that hey, these taxes are going to cost jobs. They're going to cost, you know, the family is not going to be able to transfer the farm to the next generation. Even people in urban communities trust farmers. You know, sometimes we hear otherwise, but I think most of the, you know, most of the polls that have ever been taken, farmers, as far as being trustworthy, even in the urban community, is probably some of the highest out there. So just make sure you tell your story.
Yeah, I mean, I'll build on again, and not to be too long-winded, I apologize. But you know, there's this misnomer that big equals corporate, and that's absolutely not the case. You know, there's a economy of scale that is sort of correlates with profitability and whether or not you are able to be a full-time farmer or rancher, or it's a side business, right? And even in communicating with Republican staff who are very much wanting to be supportive of the provisions that are so important to this industry, there is an absolute lack of understanding within like the mechanics of day-to-day cattle production, right? And so at one point, you know, I was ballparking, well, this is what a feed bill looks like. This is what your average input cost is annually. This is what your vet bills are. This, you know, and just breaking it down from them, and you could see like the wheels turning, but also their heads spinning at the same time, because you know, none of them realistically, or the majority of them, by them I mean Hill staff, are not business owners, but very few have any, you know, connection to ag, and certainly, you know, they're working on Capitol Hill full time, not running a cattle operation. And so there's a major disconnect, and breaking it down and simplifying, you know, this is, everybody thinks, you know, just because you're large, you're getting rich. No, that's how we keep our head above water. That story does make a difference because it's very real. And if you operate under the assumption that there's a lack of basic understanding on, you know, what end of a cow does what, you'll be in the clear. But it's very enlightening and helpful for Hill staff to hear that perspective directly from producers.
Those are some great points, Danielle and Paul. Thank you for sharing. So for young producers or new producers just getting started, what should they be aware of in the tax code?
I would, you know, I think what they need to be aware of is there's certain ways to structure your farm operation that could help save on taxes, and those savings can be pretty material for a younger producer, especially younger producers with, let's say, 2 or 3 kids or children. There's ways to structure your ranch operation, and the earlier you do it, the better. So, and also, I think even though you might be in your 20s, I think you need to spend some time planning, how am I going to transfer it on to my kids? The quicker you do that, you get involved with a good professional, they can help you understand what you should be looking at 10 years from now, 20 years from now, 30 years from now. You're going to save a lot of taxes and headaches and heartburn. So that's some of the ideas I would tell younger producers. It's hard to go into all the details on a session like this, but certainly that's what I'd be looking at.
So just for a follow-up question for that, who do you recommend in their local communities to help them navigate or help them structure their operation? Who do you recommend these young producers, new producers, reaching out to?
I think what you want to probably do is reach out to some of the people I would reach out to is maybe some of the local good bankers that deal in ranch operations, what you perceive as being the good banker. Talk to them, find out who they think the good the good advisor is in that area. Bankers are always involved in that discussion with professionals. If it's not a banker, maybe it might be an attorney. I don't think you want to dial up 3 CPAs and find out who the best one is without doing a little bit of research first.
That's really helpful. So we'll wrap it up with one more question. If Paul and Danielle, this is for both of you. If you can gaze into your crystal ball moving forward, given the uncertainties on the Hill and the tight vote thresholds, what is the likelihood we will have to fight off the harmful tax policies?
Paul, do you want to go first?
I'll go first. I think what I would say right now, we've already dodged a fairly big bullet if nothing changes. I mean, if all we're talking about is the surtax, the excess business loss changes, and net investment income tax, for most of the cattle producers out there, probably not going to get affected too much. The other proposals that were much worse, definitely much worse. So, but using my crystal ball right now, I think Manchin, if he's not a Republican yet, he's certainly swinging that way. So I think the chances of this thing, it's not going to pass by Christmas. Schumer's dreaming if he thinks it's going to be passed by Christmas, and of course I could be wrong on that. But I don't know if this thing's going to pass. I'll turn that back to Danielle to have her views on it. She's closer to Capitol Hill than I am, but I'm just not real comfortable this thing's even going to get passed.
Right, for better or worse, Paul, I'm closer to it. I'm right where you are. I would say I don't want to jinx myself. You can never say never in Washington, D.C., but Congress struggles to pass a Mother's Day resolution. This is the most controversial proposal that they will consider all year. And there is a very limited number of days in which the Senate can vote and get it across the finish line. I'm not convinced. I say there's a 90% chance they don't consider it before Christmas. Looking forward to 2022, it's an election year. We're looking at the midterm elections, and there are a lot of polls predicting that Republicans take back the House. The same is not predicted in the Senate, but that margin potentially changes the dynamics. And then on top of that, there are plenty of senators who are also in cycle. If they are not able to get it done within the first 3 to 5 months, I don't believe they'll do it at all, because they're going to be focused on campaigning and keeping their jobs, right? I don't want to necessarily assign a percentage to say it will or will not happen, because I think there's always the potential. And I would also say that depending upon the outcome of the midterm elections, there's also still always a potential that additional major legislative proposals could be brought forward by way of a budget resolution and that reconciliation process. And if that happens, these issues could come back up. But there were so many strong proponents of preserving those critical tax provisions on behalf of ag. I mean, House Agriculture Chairman Scott, a number of different individuals. Senator Tester is a major voice on behalf of ag in the Senate, who are on the right side of these issues. That I think we're in a good spot. But that doesn't mean that we can afford to let up the pressure until a deal is done, I guess, and the ink is dried. have a crazy way of working out in DC, and so it's always good to cover the bases and keep the pressure on.
Yep, totally agree.
Thank you both. That's such good insight. And just thank you again. We appreciate your time this evening, Paul and Danielle, on such important information on such a pressing topic that's at the forefront of everyone's mind. So with that, thank you everyone for joining, and I hope everyone has a great evening. Thanks, Danielle. Thanks, Paul.
Thank you, Michaela. Thank you, Danielle.
Thank you.
Bye-bye.